how much caution should we have right now?
That's right. Well, there's been quite a powerful rally, and one of the big signposts for that has been that small caps have caught up to large caps on the year. And so it is time to start looking ahead a little bit and saying, what's the next leg of this journey? For us, that means a focus on valuation and starting to pay attention to where valuation is here, where it might go going forward. And we look at that really in two ways. The first is on the financial side, asset allocation wise. You look at where yields are right now on corporate bonds. You look at where the risk-free rate is on the 10-year, dividend yields on the S&P. It seems that valuations are pretty well supported. But when you go out into the other side of things in valuation sentiment, you look at things like put-call ratio, bull-bear surveys. That makes it look like a lot of bullishness is already priced into this market. Nonetheless, we think there's a little room to go. You have things like Michigan consumer that hasn't fully recovered. That was at 90 the other day. It could go up, it was 120 in the past. San Francisco Fed looks at sentiment through an AI lens, looking at news media sentiment. That's clawed its way back to neutral, but it's far from positive. So we think that there's a little room to go, but you have to be a bit more selective here.
Okay, well, you don't sound too concerned, but if I were to look at valuations, for the most part, you could say they're high by most traditional measures historically. But then I look at interest rates and I think, well, with rates still below 1% on the 10-year and Fed funds rate basically at zero and probably not moving higher for the next number of years, I could make the argument, I guess you could too as well, that when you look at it with an interest rate lens on, we might still have a little gas in the tank. Is that fair to say?
Yeah, I agree with that view. You're absolutely right. Valuations are up towards the very top end of historical averages. You could probably squeeze a little more juice out of this with some of the improvement in sentiment, some of the excitement that we get once we start to see COVID cases come down. Maybe we get a little bit of relief from some of the other bricks in the wall of worry falling out. But you have to be cautious here and have to be selective as well.
You like financials?
We do. We think that you want to look to the parts of the market where the economy is going to be helping you. In a normalizing economy, which we think we're going to see next year, stronger economic growth. As you said, Fed staying out of the picture on the short end. Maybe the long end drifts a bit higher. Steeper yield curve, traditionally better for financials. And we think you're going to see a jobs recovery. We think you're going to see that sentiment numbers pick up a bit once the COVID situation gets better. Consumers got some pent-up demand. We think consumer discretionary looks good here. And then lastly, we think there's going to be a big focus on putting all those folks back to work. There's a lot of unemployment out there. Policy focus, job number one is probably going to be jobs. We think that means whether it's infrastructure, onshoring, or otherwise, that helps companies in the industrial space.
Shepard Smith here. Thanks for watching CNBC on YouTube.